Euro, US dollar price forecast, depressed in range. United States Red Book Index, year over year, fell from previous 7.1% to 5.7% in January 9th.
U.S. stocks may see initial strength following inflation data.
Russian captain did nothing to avoid U.S. tanker crash, UK prosecutors tell trial. Breaking, U.S. CPI rose 2.7% year over year in December. U.S. dollar, buy on the subpoena, sell on the indictment. Stand chart.
ADP employment change 4-week average edges higher in late December. United States Consumer Price Index NSA, MOM, dipped from previous 324.122 to 324.054 in December. 90 seconds. Better reload that coffee, huh?
Reload! Reload! Yeah, boy!
Hey, good morning. Stock market's open. Ding, 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 ding. How are you? Comment allez-vous? So, welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble. Focus on the long term and never risk money you cannot afford to lose. Hey, my name is Wayne. Nice to see you. Good morning. Hey, CPI as expected, but hey, it's not up. Maybe that's good for things, huh? Maybe that allows the Fed to continue to normalize, aka cut interest rates. So we can look at the fair market value later today on the yield curve, or using the yield curve for fair market value. We could also look at the 5s and the 10s and all that kind of stuff. So anyway, so that is all happening. And if you want me to, I can look at the Fed Fund futures market. Okay. Boy, I'm a disaster today. Yeah, I just finished eating my lunch. I know it's 9 o'clock in the morning. Is that better? So anyways, there's lots that we can do technically and fundamentally using TRADARS as our analytics platform, Traders Way as our execution partner. Perfect partnership. So it's going to be a great day. Lots of news. In fact, we got real estate news coming up very soon as well. Let's go. Bum, 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 ba-da-bum, ba-da-bum. All right, so we're just kind of burning through some charts here. What's going on? It's great. Bullish with the bullish setup. Bullish with a neutral scenario. Bullish with a bullish setup. Bullish with a bullish setup. Bullish with a bullish setup. Hey, good to know. You're like, Wayne, but I don't like 15-minute charts. Can you give me a better point of view? Maybe a bigger point of view? Maybe instead of daily pivots, can you do weekly, monthly pivots? And can you do trades that can last, longer, maybe hundreds of pips instead of dozens of pips? Yeah. So we already covered all of this at traders.com. We do a session. We already covered all this, but for those that are not in the know, now you know. And so we even look at overlapping pivot points over longer periods of time. But our best case scenario is a confluence of both monthly pivot points and standard deviation from a linear projection plus the standard deviation, right? Yeah. So anyways, cool stuff, cool beans. Let's get an update on the headlines. Gold hovers near record highs after mixed U.S. CPI report.
U.S. dollar Swiss franc trades mixed as U.S. inflation. Fed independence concerns weigh on dollar.
Platinum rises but remains below December record, Commerzbank.
Euro U.S. dollar consolidates as U.S. inflation data reinforce cautious Fed outlook. 3 reasons why copper prices are surging. Canadian dollar little changed amid firmer U.S. dollar and MXN gains, Scotiabank. Euro U.S. dollar price forecast depressed in range. United States Redbook Index year over year fell from previous 7.1% to 5.7% in January 9th.
Cool. We had CPI 2.7. You might use core and all that kind of stuff. Well, I'm most interested in year-over-year change. ADP, the 4-week average, added a few jobs. So there's 2 things going on. Half the Fed is worried about inflation skyrocketing. The other half is worried about employment collapsing. So based on today's news, employment's not collapsing, inflation is not skyrocketing. Therefore, interest rates are too high and they can normalize. Cutting doesn't mean slashing and burning interest rates because the economy is crashing. No, they're too high. They're too far above the neutral rate. And, well, the worry is if they cut interest rates, inflation comes back, therefore you shouldn't. Well, inflation is, 2.7 is not 2.0, but it's not 4.0 either. So, and yet we're adding jobs too. So, you could cut. You could cut. There's no need to cut to save jobs. So you might interpret that different. But cutting may not necessarily be negative for inflation. So You can hash this up any way you want, but this is why we have other tools. And you may see that dollar is weak and yen is even weaker. So you should have been on the yen's, since the beginning of the year, because the seasonality on the yen. Right? So anywho, we have the data. You should know the yens are normally weak, and they are weak. And yes, there is potentially a snap election coming in Japan, for sure. Debt levels are redonkulous in Japan. Yeah, for sure. Rates are going cray-cray. Yeah, for sure. But it's also normal in January. And I have in my brain the next 6 months of normality for those yen pairs. But I can also just pull it up in the fundamental section and do it whenever I want. I just happen to be doing it for a couple of decades, so I got a lot of it stuck in my brain. So, very cool. New home sales is going to be important because it's related to CPI. Yeah. And we're wondering, like, maybe if interest rates come down, then maybe mortgage rates come down, and then maybe
US dollar Canadian dollar technicals. The US dollar
maybe existing home sales increase, and that increases GDP and a bunch of other things. And that makes the stock market also go up. I mean, it goes up because of that, but because of the same reason, that would be beneficial. Okay? Right? Let's see if we can remember this. The expected return of an asset is equal to the risk-free rate of return plus the beta of the expected return for the market minus the risk-free rate of return. Right? So if mortgage rates fall, the value of your house goes up. If interest rates or borrowing costs, if you want to think of it that way, if borrowing costs for businesses fall, then the value of the company goes up because they have more money left over. Instead of paying it in interest, they have it in profit. Profitable companies, value goes up. And they're all related. Do you guys use this, or do any of you use like discounted cash flows as your valuation model? The current value is equal to the future value at period 1 over 1 plus I to the n. This is a 1, not an I. Plus the future value 2 years from now over 1 plus I to the n. Well, in this case, this would be a 2. This would be nothing. Technically a 1, but doesn't make sense. All right. So anyways, that's how all that works, right? And you can dot that out into the future. The variables here are the income and the interest rate, or income and inflation. Same, right? Here, most people use like the yield on the 10-year T-note. You could use the yield on the 2-year. I mean, these are variables that you can change. B is beta. Beta is beta. So if you understand the relationship, let's say, of the real estate industry relative to the stock market and interest rates. So the stock market would be your gauge of risk on, risk off appetite in general in the market. And right? So we have to watch all these things just to get a sense of what's going on. Well, that's why we have a sentiment tab, by the way, because you want to start every day kind of getting a feel for how people feel. Because you're not necessarily trading the market. You want to figure out what the market is doing and go along with it. You're not big enough to beat the market. Okay? You don't want to try to outsmart the market. There's millions of people, and you think you're the smartest of them all? Smarter than the aggregate of smart people? That's a tough one. You probably need inside information for that. So what can you do? Figure out what the market is doing in general, go along with it, and ride the wave. Hey, when you're surfing, face the beach. Go with the wave. You're like, Wayne, I don't really get that. Yeah, well, whatever. Go along with it, huh? Go along with it. So how do you guys feel? Are you risk on or risk off in general? Don't worry about today or yesterday or the day before or the day before that. So here's Monday's recording, yesterday's recording on YouTube. So that's good. That's happening. And once we're done this live stream, this gets updated to Tuesday. Cool. Yeah. So this is long term. You're like, well, how can you be risk on today, Jim, if it's negative 2.3, eh? Well, Jim is astute because he's looking at multiple time frames. There's short, medium, longer term, and the aggregate of all three. The aggregate of all three is negative 2.3. So long term, it's still not great, but it's a lot less bad than it used to be. And that matters, doesn't it? Oh, for sure. Aiden says, I'm seeing a current risk score of negative 2.04, indicating a risk-off sentiment prevailing in the markets. The stability in the 10-year yield, I mean, we've been sitting here now for weeks at this level, has been crucial, preventing any shifts in risk perception. While minor improvements in Forex majors, especially in Kiwi dollar, indicate cautious trading rather than aggressive positioning. Cool. This gets updated many, many, many times per day. This was updated just as we started today's webinar. Every time you come to this page, basically, Aiden thinks and then gives you a report. This is why we call it a sit rep. Now, I used to have him give a much more detailed report, but I'm not sure if he would actually read it. But to get the more details on the risk sentiment, short, medium, long term, and aggregate on all time frames, you just go to the risk radar. That's where we get this number. You guys following me? It's all good? You alive, number 5? Okay. What do you guys want to look at next? Day trading? Right? The day trading radar, the swing trading radar, or the position trading radar? What do you want to see next? You tell me, boss. Look at this risk updating in real time. Did you see it pop up? Say trading. Oh, well, that's hard to, yeah. Day trading, swing trading, position trading. Yeah. All right. Really? Day. Everyone's a day trader? That's cool. We can do that. I'll click the button for you. So Nasser says dollar pairs. Now, let me ask you a question, Nasser. The Japanese government is calling for a snap election, even though they just got a brand new prime minister. And rates at the Bank of Japan are going cray-cray. And their debt levels are now unsustainable. And seasonality says you should be selling the Japanese yen. So now you got like 5 things that say sell Japanese yen. Why are you so fixated on the dollar? The dollar actually hasn't done much at all in the last 6 months, has it? TT, January is not really a risk-on month. It's not. I mean, no, I wouldn't simplify it like that, TT. Yeah, I got it, Emil. I got it. It's my next thing. Fixes are made and then it goes away. I'm not sure why, but yeah, I'll keep at it. Yeah. So, anyways, I want to share that with your Nasser. You're like dollar pairs, and they're not bad today, but you're missing a much bigger move. The yens are nuts. That should be your first priority. But if you don't know that, then ooh la la, we've discovered an opportunity to sharpen the saw. Anyways, Jim says he's bullish today, and that is correct. Statistically, if you analyze dozens of things. Oh, okay, the yen pairs have peaked. Okay, what I can look at that later. You might be right. I'm not looking at that part. I'm thinking fundamental. So you think they've peaked? Like, for example, I think the yen pairs in general, not necessarily today, tomorrow, but generally, let's say in the next week, the next month, the next quarter, are normally go up versus down. So you say they might have peaked. I don't know, peaked today, peaked this week. Did we just hit the weekly pivots? Yeah, but there's still, like I looked at, what was it, pound yen, and there was 550 pips left in the January move if it continues. So you're like, well, it peaked today, but yeah, well, I'm looking out 3 weeks from now. So it really depends, right? Now you're still doing a dollar pair though. So, okay, so now today the dollar's weak. Oh no, that's TT. Sorry, I thought that was Nasser. Yeah, dollar's weak, but so is yen. Dollar was strong yesterday, but things have changed. Yeah, so going back to what Nasser's saying, and sorry I'm jumping all over the place, but this is great. This is perfect. Okay, Nasser, if you are long-term long, like swing or position trades, the yen pairs, you think pound yen, euro yen, Aussie yen, Kiwi yen, whatever, that in general, they will be higher 6 months from now and 3 months from now. So if today we peaked and there's going to be a dip, that's a buying opportunity. And this is why I teach people when we come to the New York session like this, Nasser, if you're only trading today's session, you're way behind. So what we're supposed to be doing, Nasser, and you might be correct here, is log into New York and you're like, oh my God, we basically peaked out on the yen pairs. Yeah, well, you should have bought them in Asia and rallied them all the way through the London Open and all the way into the New York Open and taken profit. That's how you're supposed to trade, by the way. Let's just cut to the chase on that. So New York is about adjusting for tomorrow. So then going back to that logic, Nasser, you're like, okay, I'm bullish on all the yens, but they all peaked out today. I'm going to take some profit or move some stops, whatever. You do whatever you need to do. But now you start calculating, well, where in the next 6 to 12 hours am I going to buy more yen pairs? So like, let's look at pound yen. Let's see if we can get it on the technicals. I'm having difficulty with some of these. Okay. Yeah, so I see what you're saying. We're at an R3 right now. Cool. So what do we need to do next? And let me zoom in this way instead of popping it out. Let's see. Is it going to let me? Is it going to let me? Okay, a little bit better. All right. All right. So what do we see here? Okay, we've done this. Now, R3, as Nasser says, is extremely overbought based on what happened yesterday. That's all. It's an implied volatility. Based on what happened yesterday, then that's as extreme as you could possibly statistically, mathematically expect. If you expected to go here today, you might be right, but it wouldn't be predictable or rational based on mathematics. Okay? So we look here, we look here, we look here, but our ultimate base case scenario in the futures to get to that price, and the best case scenario is to get to that price. So it would probably look like a dip. Okay, you want to measure roll reversal. So somewhere around this zone here. Okay, we would plan for something like this and get it to our base tomorrow, which means we're here now, but in, let's say 3, 4, 5, 6, 7, 8, 9, 10 hours from now, we probably want to buy it back or buy more here and take it probably here, maybe here. Now, the best case scenario often will take 2 days and you need another pullback. Cool. And we call that price action. We call that trend. Okay, this score here, Aiden's bias is bullish. 60% of that is based on fundamentals only. It has nothing to do with this chart. And then the other 40% of technicals would include multiple time frames. So really, Aiden is not even really looking at this chart. Just like, dude, in general, we're bullish on this, done. So like when I say, oh, yen pairs are going to go up for months, oh, well, that's kind of like what Aiden's doing, except he can actually see it. I remember it, but I have to double and confirm everything. Luckily, I have the data. Now, this is just this chart. You can be bullish, very bullish. You can be neutral. You can be, it gives you all kinds of warnings. But in general, okay, we've done really well. I'm going to expect bulls selling, not bears. So I'm not worried about a reversal. Price comes down, bulls buy it back. Goes up, bulls sell. Bulls buy, bulls sell. Bulls buy, bulls sell. And then the slope can increase or decrease depending on their change of aggression. And do we track slope? Yeah, we do. Yeah, we track the slope. Because the slope is an important aspect of all this. Let's do the math again, since I already did math. Okay? Y equals mx plus b. Okay? So that puts this whole thing in a grid. X and Y axes. B is the intercept. M is the slope. This is the slope. Slope is equal rise over run. Okay? Calculated by this. Okay? So now you have the mean, the average is right here. But every time there's a new dot, and there's in these lines, there's lots and lots of dots. There are infinite amount of dots. So the current dot with that slope, all you have to do is continue in a line into the future. That we call that linear projection. And then you look at the variance from that slope, variance, 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 so on and so forth, going all the way back. You take the square root of the variance and you create a standard deviation. And that's how you get these projections of base case, best case, worst case scenarios. And all of this is being done on multiple time frames and adding the right moving averages, calculating in the back, even though it's not showing you, MACD to give you aggression levels of current trend. Trend is up, but how aggressively is it up? So now in the back end, it's using MACD for that because I taught it how to do it. And then recognizing that it's fundamentally and technically bullish, and then putting down only the correct pivot points for this particular time frame, for this particular setup, and these prices are all live. Holy schnicker-schnocker. So all I'm saying, bro, is, yeah, the dollar pairs are good, but make sure you're not missing something even gooder. Those dollar pairs ain't bad, but the yens have been outstanding. So look at pound yen. It's okay. Look at USD yen. Like you said, Nasser, I agree with you. Today, it's overbought. What about swing trading? Where's that USD yen? There it is. Okay. Is it overbought here? No. It's expensive. Okay, so let's show it here. And again, let me zoom in so we can really see it. By the way, is this a good conversation? Is this helpful? Did you click thumbs up? Did you tell YouTube this is good? So, bullish, but warning. This is what Nasser is saying. Nasser's like, yeah, I'm bullish, but you know what? We've topped out. Yeah, we've topped out this week. Now, we might be able to get way up here. There might be a next leg. But it is a warning that it is overpriced from the swing trading, right? And this is a combination of weekly and monthly. Notice, like, now we're plotting monthly pivot points. Okay? You're like, wait, monthly pivot points? Yeah, way up there is what we're looking at. The best case scenario based on linear projections, and that shows you how fast USD yen is moving up, is blowing the doors off the monthly. Based on statistical analysis of what has been happening, which does not predict the future, but if we kept going up at this rate, remember the monthly pivots are based on what happened in December. This is not December, son. We got snap elections in Japan that was announced just recently. Like, that's new. So this might be an acceleration of yen weakness. Great. So based on what happened in December, we can expect, or you should take profit way up here at MR3. But based on what's actually happening on price action right now, we can go even higher, all the way to 163. And this changes every day, by the way, because we get more and more data. You're like, 163, Wayne, we're only at 159. Yeah, there's 400 pips. 400 pips left in that, and we should be able to do it in the next 2 weeks. Is this a nice swing trade analysis? By the way, look out for the confluence, which we are hitting here. So I don't know if you noticed that, but Nasser's like, oh, well, we might be overbought. Well, I'm looking at the overlap, aka confluence, of monthly M4, weekly R2, and monthly M4 and weekly M4. So we're at a weekly high and a monthly high. Don't be shocked if we get a pullback. The question is, are you ready for the pullback? And if it occurs, do you have the confidence and strength to get out of bed and do what needs to get done? And that means buy the dip. Well, I don't know, Wayne, if it'll keep going up for another few months. I heard on blah, blah, blah TV, yada, yada, yada. Oh, where should confidence come from? I'm good enough, I'm smart enough, and gosh darn it, people like me? Or because you have the data? So what did I say? I'm bullish till July. Why? Because I know the yen pairs year after year after year after year. Generally speaking, not every time, but I have the data. So I only have 20 years of data. I'm sorry, only 20 years. In the last 20 years, it goes up until March, but we also, and then it fizzles out. But we also know that's when the stock market's going to drop. Well, Wayne, how do you know that? Well, I don't know it, but I have the seasonal data. And then what? That's 20 years worth of data. Okay. And how much volatility is in here? So look at some volatility, a little more, lots of volatility down. Volatility's bad, son. And then what? Volatility collapses and the yen pairs start going back up until June. Somewhere in June, it peaks out and it's the end. This is the end. Yeah. So I already got the whole year planned out. Like, oh my God. So if you're an amateur trader and you're looking at this and you're like, dude, this guy knows all this. He knows all this. Yeah, what you should be saying to yourself is you can't compete. Yeah, you might win, but I'll probably win. I think the odds are in my favor. The odds are in the favor of those that know. The truth through knowledge versus your random trading. Well, the YouTube guru told me to buy. Right? Yeah, whatever, bro. Got to have the data. You got to have the data. If you don't have the data, you don't know. Okay? Dude, pretty cool though, right? Just at your fingertips. Let's look at what the USD yen has done over the last 20 years. And then plot the volatility of each of those months over all of those years. Yeah, done. Hey, Bitcoin usually goes up in January. Did you know that? Well, I'm long Bitcoin. Hey, we went from 85, probably on our way back to 100. Why? Well, I've analyzed it on the long term. We did that yesterday. Right? Was that this morning? Could have been this morning. So cool, right? So, Fed funds rate. You can look here and say, we're stuck. Look at 30 days ago, the yield was 4.18. Today, the yield is 4.18. A didn't notice that earlier. Okay. So that's that. Now, historically, the Fed had their Fed funds rate about 1% lower than that. Sometimes a little more, sometimes a little less, but let's just dumb it down. And if I'm wrong, just do the research, find out what the right number, and plot in your variable. It's just a variable. But if you don't know the logic, then, okay. So let me share some logic. 10-year T-note is typically 1 basis point, 1 percentage point, 100 basis points lower than the 10-year T-note. All right, 10-year T-note, 4.25. Somewhere between 4.25. So that means the Fed right now, today, could cut to 3.25. And everything would be normal. Right now. It would not be unusual. It'd be shocking that they just came out and did it. But right now, interest rates are too high, according to the Treasury market. Not Trump, not politicians. Okay? This is millions of investors, most of whom are institutional, investing trillions of dollars, and they all agree that that's the price and the yield of the 10-year T-note. And they haven't changed his opinion in a while. That's why the dollar probably won't change in a while. Here's the thing. We also need to watch the shape of the yield curve to see if yields start falling or rising. Now, what does this mean if yields fall from 4.18 to 3.5, we'll say 3.75? What does that mean if we're watching the flow of capital? First of all, this would be green. Yields would fall, so, right, the yield curve would drop here and steepen there. What does it mean for the Fed funds rate? Dude, you are learning how to be a foreign exchange trader. I hope you know that. You're like, dude, I don't do any of this. I just trade euro dollar. Oh, you can't understand why the euro and the dollar change value? This is what I'm teaching you. Okay? If this drops to 3.75, the Fed could now consider the neutral rate 2.75. So they could drop interest rates to 2.5 to 2.75. Oh, what do you think would happen? Dollar down, stock market up? Huh? What do you think? Bitcoin up, gold up? What do you think? So if you don't understand this, I don't know I should say it this way. If you don't understand this, you will not know how to prepare for it. You won't have the ability to do any strategic planning. Remember my book, Strategic and Tactical Forex Trading. So you start with the strategy and then use technical analysis to confirm and deny that strategy. You're like, based on all these reasons, I'm bullish. Okay, good. Are the charts bullish? No. Well, then don't buy it now. Wait till it turns bullish. Is it bullish now? No. Is it bullish now? No. Is it bullish now? No. Is it bullish now? Yeah. Great. Buy the next dip. This is all it is, guys. Ladies and germs, that's all it is. You have sound, logical reason why an asset will appreciate or depreciate. Once you understand that, then it's either happening or it's not happening. You either understand or you don't understand. You either predicted it right or you're not trading. Think about your consistency. Think about your confidence. Think about your account when it's 10 times or 100 times bigger than it is now. If you got there through luck and randomness, you will not have the confidence to be able to handle an account that size. And because of that, you'll never get an account that size. Because you're not making logical decisions. You're winging it every day. You're random. Like a candle in the wind. Yeah. Have I made my appeal? Like, dude, get off the Get off the soapbox. Vote for me! Come on, everybody! Let's go! Yeah. Hoorah! So anyways, sorry, I love what we do. The most passionate man in Forex. Especially if this chart loads, which I don't think it's going to load properly. But maybe I can use it to get my my point across here. I don't think it's going to load properly. Let's see. Okay, let's see. This is going to be glitchy. Again, let me pick on Nasser. Nasser, are you okay, Nasser? Let I pick on you? That's good. I'm like a pit bull, man. I grab on and I don't let go. But out of nothing but love, I'm a teddy bear that's going to maul you. I'm a teddy bear with claws. All right. You're like, hey, check out the dollar pairs. Okay, well, it's a little better. It's still glitchy. You can see that glitch. We're working on it. Trust you me. United States new home sales, MOM, declined to 0.738 METs in September from previous 0.8. Okay. Hang on. I'm just seeing if I can fix this while we're here. But anyways, we can still see it. It's just struggling to draw the historic price line. But what we're showing here is long-term, medium-term, and short-term trend. Why? Because it's called a trend radar. What do you think I'd call it? Yeah. All right. All right. So it's like a moderate opportunity. It's not long-term bullish. It's actually long-term bearish. But the slope, remember I was talking about the slope? The slope is a negative integer, but it seems to be slowing per hour. So we calculate the slope and then update it every hour and then calculate the change in slope per hour. Yeah, dude, serious math going on here. And this is the standard deviation. On the long term, medium term is in green, it's bullish. In fact, very bullish. And then short term, not bullish. Well, if you're doing like sort of a day trade, you want the up, down, and then tomorrow up. So that would be your dip. The only problem with this is on the long term, it's neutral to bearish. So it's okay, but it's not great. So we want to compare short-term, medium-term, and long-term for all assets. Okay? So what about, let's take a look at this one now. There we go. All right. Same numerator. All I did was change the denominator. Okay, Nasser? And this is where I'm getting at. And by the way, Nasser, when you're trading multiple asset classes and you're looking at a bunch that you like to trade, but they've already hit their short-term targets, like the daily target or the weekly target, then you're like, well, you'll roll over to other assets and see where they are. And you know, maybe yens are fading while dollar pairs are topping. you see? And then you just roll over. So now let's keep the pound, but switch out the dollar for yen. Long-term bullish, medium-term bullish, and there's a little bit of a dip going on. Well, we want to buy a dip in an uptrend, a strong uptrend. Day trade, swing trade up. So we should be going to our charts now, looking for a buy a dip scenario. You get it? You see how helpful that is? So you're like, oh, well, I like pound dollar, but this is better. And this is just pure technical analysis. Can you guys see the power of that? You want to see short-term red on a long-term green. That's what you're looking for, buying a dip in an uptrend. Put it this way. Let me ask another rhetorical question. If all you did was buy a dip in a long-term uptrend or sell a rip, meaning a rise, in a long-term downtrend, how would it impact your trading? Well, first of all, you'd be incredibly consistent, which means you have tons of control. Huh? Right there. Control and consistent right off the bat. What do? I buy dips in an uptrend. But you're not fighting the market anymore, are you? You're riding with the market. The market trends. And you're actually a trend trader. You'd have to think about what's the probability. If you're trading in the direction of the entire market, are you more likely to lose money or more likely to make money? Now, if you buy high in an uptrend, that's probably the next mistake that you're making. So that's why I add this scalp trade. You actually want to see red candles. That's not a red flag to be worried. That's a, hey, open this pound yen and start doing some technical analysis, bro. Buy a dip, buy a fib, buy a moving average, buy an oscillator, buy a roll reversal, buy a psych level. Do something. But chew on your fingernails. And now you can just burn through the entire market. Okay. Now it's a little slow with this glitch. I'll get it going again. But you're able to just burn through everything bullish and everything bearish. Just boom, boom, boom. Or you just use it as a compass. Okay. Bearish, got it. Bearish, got it. Neutral, neutral, neutral. Good. Stay away from those. Bullish, 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 very bullish, very bullish, very bullish, very bullish, very bullish. Cool. Done, 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 done. Well, the basics of technical analysis is you'd put it below the pivot, right? Like the very basics. We're in a bullish market. And so we analyze all that and we say this is the weighted central pivot. I'll try to make it as accurate as possible. This is the M2. Okay. And our target's going to be M4 to R2. And if we're super, super ridiculously lucky, R3. Okay. And these are pretty close to being what they would be. Okay. A weighted mean is slightly above the midpoint, all that kind of stuff. So where's S1? S1's way down there. Why is S1 way down there? Well, my rule is a 786 or less predicts either a top or a collapse. So this is your logical buy zone because we want to buy a dip. Okay, and that's what we expect to happen. Therefore, a stop now can be below the here or here, meaning, below the lowest low. But S1 is probably good enough because S1 is typically going to be a 786. It's going to be below a 618. If you're going to use Fibonacci, just think of this as a 50. Think of this as a 618. That's your buy zone. And you'd probably consider this a 382, 1382, 1618, and 2618, right? And so it doesn't matter. You're like, Wayne, I hate pivot points. Well, just use Fibonacci. Wayne, I hate Fibonacci. All right, use Elliott Wave. Wayne, I hate Elliott Wave. I sound like that guy from the Smurfs, right? Then use some moving averages, bro. I hate moving averages. Then use a MACD. If you prefer price action, use stochastics. But you need to understand the math of what's going on. They're all generally the same. Different math to do the same thing. The thing is, we got to get there quickly, right? So you might base your stop based on your perceived reward, which then gets you to a risk-reward ratio. But remember, the market doesn't know what your target is. It doesn't know your risk percentage. The market's not trading your math. If you do it that way, you're probably going to be okay. But you want to do what everyone else is, base your stuff based on what everyone else sees, and everybody can see this low here. And if you've done this long, medium, and a short, medium, and long term, then probably, if the long term says up, this will probably continue going up. What's the likelihood if the probability is up? What is the likelihood we make that lower low that everybody sees? Quite low. You probably won't get knocked out. Okay, well, that's good probability then. You'll probably stay in. You will probably continue with the trend if the trend continues, and the trend will probably continue, in particular if it was based on fundamentals. This is why our trend analysis is 60% fundamental. But you will probably not get knocked out. But if you do get knocked out because price does reverse and make a lower low, you do want to get out. Because the market reversed versus, did one of these little whipsaws on you, takes you out and goes. And you're like, oh man, I got whipped out. Well, it's because you put a stop that was mathematically logical to your account size, but not statistically relevant to any other trader on earth. So you might do it the other way and say, well, how much risk can I take to put my stop there? Well, I probably won't get knocked out unless the trend reverses, and then I do want to be out. Well, you might only be able to risk, instead of 0.25, maybe you can only risk 0.15, which means you can have the same target because the target shouldn't change. It's a day trade, a swing trade, or position trade. You're either weekly, monthly, or daily pivots. Like that shouldn't change, but the lot size would change. Okay. You see? So the variable that I'm not sure about is your 0.25%. Okay? That should be the variable, not the target. And the stop should always be below support in an uptrend. And your 0.25 might be nowhere near support. It might be close to support, which is even worse. Comes down, you get close to support, it hits you, takes you out, you take the loss, and then it goes up because, well, now it's near support, but you put your stop above support instead of below support. So I'd rather you have the lot size as a variable. And by the way, a message to everyone, not just Hope here, but to everyone. You're over leveraged. Lower your lot size today. Trust me, bro. Trust me. All right, let's see if Aiden did anything. Oh, wrong one. Let me see if he fixed it. I don't think he's quite done. Let me try that. What do you think? Good advice? That you just can't take. And whoever thought it figures. Hey, I'm Canadian. I can't help it. Yeah, dude. Let's see. The front end glitch is still there. It's just it even takes a while to load. I will keep working on it because I love the tool so much. It's just not rendering the front end of the price line, but that can't be difficult to fix because it's actually drawing it. It just stutters. Huh? Spit in the mic. All right. Well, I'm spent. I'm done. Think that's it. Did you click the thumbs up button? This video will be available in the TRADARS platform. For those that are not a subscriber, did you know it's free? Yeah. You're like, what? Shut the back door. Yeah. What's free? This entire sentiment tab, the squawk box, the situation report, all the day swing trader position, the risk radar. We didn't even do the contrarian radar, and the trend radar. All of that, all of this can be yours, and no one gets hurt. And if you like the other stuff, don't worry about it. You can upgrade. It's only money. It's an easy club to join. You got money? You're welcome to join. You don't got any money? Use the free stuff. Sit at the back of the room. But you're a part of the community. Free, dude. Free. So you take traders.com. Free. You take tradersway.com. Free. And you got a winning combination. Silver just hit our target. Okay. So last week we had a target of 88.88. Can anybody here confirm this? Anybody here confirm $88.88 as a target from our meeting? Anybody here? Boop. Okay. That means that. Okay. And what do these lines mean? And let's see if I can find it in the TRADARS platform. Oh, I just logged out. Where is the methodology? Where did we put it? Would it be fundamentals? I have it all written down, and I've been teaching this for a million years. Is it here? No, no, no. I have it in our different methodologies that go into all of this, but here's what I'm trying to get to. We have a standing rule, and we describe these targets as you could take profit, okay? Could take profit at the dash line, profit target conservative. Should take profit, okay? See, bullish profit zone aggressive. And there's one more. That's way up here somewhere, and it's an monthly. No, it's a weekly R3, and we call that must take profit. So we just slammed into you should take profit for the week. You should be pretty happy with it. Doesn't mean you have to, but what more do you expect, bro? Well, I think it's gonna go to 100. Yeah, well, you might be right, but it would be very unusual for it to continue at this rate to do that this week. So another way of looking at it is if you believe in price action, you probably look at this top, you probably look at that bottom, you probably drag it across and say, well, okay, we could probably take a break here, come back down into the moving averages and go up next week. Yeah, do you see this? I already have it planned. Do you see it? That's the buy zone for next week. You shouldn't just be interested in silver now. I'm already planning next week. What day is it? Tuesday? Dude, as far as I'm concerned, Tuesday's done. Tuesday's done. This entire week is done. Could it go higher? Yeah. But it's a lot less likely than before, so I'd rather just buy a dip and take it up to 100 later. Okay, I could take profit here, and it would be perfectly fine. And here's the thing, I also, in my book, I talk about the law of averages. If 50% of the time it goes up and 50% of the time goes down, if you just take the profit here, you get the same result at the end of the year. So why stare at another trade? Take the profit, move on to something new. There's another new trade developing somewhere else. This is an old trade. This horse is old.